key trends, key developments. My name is Lanre Akinola. I'm the head of content here at NABA. On behalf of the Norwegian-African Business Association and our co-host Norfund, a big welcome to you. After the last 24 months, we all know what it's been like. Making predictions about the future has become very risky business. But over the next 2 hours, we are going to do our best to provide some insight into what some of the defining issues and trends are going to be for the year, and some of the important things that you need to be aware of and need to understand that are going to shape the economic, business, and policy landscape across the continent. The session, we have 2 hours for the session, and there are 2 parts to it. The first will be a series of presentations, and we've convened an expert panel of speakers, each of whom will run through some of the key issues that they believe will define 2022. By way of very brief introductions, joining me today as my fellow speakers are Razia Khan, who is the Chief Economist for Africa at Standard Chartered Bank, Simba Mutasa, who is the Regional Director for Southern Africa at Norfund, Robert Hutchinson, who's a partner with Control Risks in East Africa, Wale Shonibare, who is the Director, Energy Financial Solutions, Policy and Regulation at the African Development Bank. And finally, we have Jens Thomassen, who is a partner with AP Møller Capital. Each presenter will have up to 15 minutes to outline their take on Africa in 2022. You don't have to use the 15 minutes, but 15 minutes is the absolute upper limit of what you are allowed to do. Now, we have a lot of material to get through, a lot of ground to cover, so I'm not going to waste any more time on the introductions, and I'm going to hand over to our first presenter of the day, Razia Khan of Standard Chartered, who is going to give us a bit of an overview as to what to expect from the continent over the next 12 months. Razia, over to you.
Thank you, Lanre, and good afternoon, everyone. So that's going to be a very easy achievement in less than 15 minutes, what to expect from all of Africa. No doubt there's an exciting session that's lined up for everyone. At Standard Chartered, we're honoured to be a part of this, as we do a lot more with our clients in the Nordic countries. And we hope to have a very lively Q&A discussion. So without wasting too much more time, I'll jump right into it. We know that 2020 was an enormously testing year for the global economy, not just for sub-Saharan African economies. 2021, a year of very uneven recovery, uneven vaccine access. Africa lagged behind very significantly. In terms of access to supply of vaccines, it is improving, but there are still concerns about the impact this has. Nonetheless, we take some reassurance from the fact that in 2021, off a very weak base, we did start to see a tentative economic recovery. The reopening of developed markets, the resumption of global trade growth, recovering a lot faster than had been the case after the global financial crisis. All of this feeding into higher commodity prices and helping to lift prospects for some African economies. It is still the case that a lot more needs to be done on vaccine equity. The supply issues of vaccines, access to vaccines, the logistics around vaccine administration, this remains a potential threat to the outlook. Nonetheless, we take some comfort from the experiences in South Africa during its recent Omicron wave. This came and went fairly rapidly, although the case numbers rose very rapidly. We didn't see anything like the same degree of hospitalizations, anything like the same degree of fatalities that we had seen with earlier waves such as that of Delta. And this gives us some reassurance that maybe even looking to the Africa region's ability to cope with what lies ahead, we can make some assumptions about growth. The hard lockdowns, the very restrictive containment measures that wrought so much damage to African economies, the hope is that we can draw a line under that. The expectation is that maybe we are at a stage in the COVID crisis where we can hopefully rule out the resumption of that sort of hard lockdown. This does mean a normalization of activity. The tourism-dependent economies will hopefully see much more recovery in 2022. And from that sense, the outlook is that much brighter. A word of caution, though, let's not place too much emphasis just on the bounce back in GDP alone. And yes, we are going to be seeing something of a more muted recovery in some instances because of global factors being the way they are. First of all, in 2021, we were measuring growth off a base where we had seen contractions, weak contractions, deeper contractions in many economies, and that's not necessarily the case in 2022. Second, we know that part of the consequence of developed markets having been able to reopen so much sooner means that we are very likely to see a tightening of global financial conditions. Everyone is looking at how quickly the Fed may need to tighten policy, not just raising policy rates, what the expectations are around balance sheet reductions, not just for the Fed, but the rolling back of the monetary policy accommodation that we had seen in many different developed market economies. What are the consequences of that going to be for capital flows into emerging and frontier economies? But perhaps the most serious issue that we think we need to be looking at this point is that of the development fallout, the very real development fallout that we had seen as a consequence of the crisis. Take the example of Uganda, reopening schools after almost 2 years of closure. What does that mean in terms of the lost education opportunities for children, both in that region and elsewhere? What about the missed immunizations? How has healthcare capacity been impacted? What about the ability of governments to deliver? And in a much more economic sense, we know that we're still dealing with the aftermath of the crisis. The kind of damage done to the balance sheets of different sovereigns is going to take a while to repair. We know that the days of easy access to financing, super turbocharged growth on the back of government infrastructure spending plans, borrowing heavily to be able to invest heavily, growth models being overly dependent on that, we can probably say goodbye typically to that kind of growth model as well. The kind of growth that will be seen in sub-Saharan Africa may be more difficult to achieve in a region where the public sector has played a key role in driving growth momentum, where public spending has played a key role in overall investment. The years ahead suggest that African growth will need to be better balanced. This is a time where the private sector will have to come into its own to play a greater role in terms of driving growth, given the balance sheet disrepair that we had seen at the sovereign level. And the question is, can it be done? Will we see the broader and big embrace of reform that allows all of this to happen? A very key consideration for African countries that saw the accumulation of much greater levels of debt over the course of the COVID crisis is how they deal with it now. What do countries across the region need to do to be able to reassure on macroeconomic stability, relative macroeconomic stability, to be able to reassure on those debt ratios that had ballooned during the crisis as a consequence of the weaker growth, of the wider fiscal deficits, of government attempts to try to deal with the fallout of the crisis? Let's recognize that for much of Africa, for many of the frontier economies, we're not dealing with a situation that is anything like we saw in developed economies, where monetary policy was able to be much more accommodative, where there was a significant fiscal boost to growth, a fiscal support given even to the household levels. In a lot of sub-Saharan Africa, we're seeing in country after country, households having run into their savings to see them through that difficult time during the COVID crisis. Private sector credit growth emerging relatively weakly from the crisis. And the key question is, how easy is it going to be to fix this? So there is necessarily a focus on reform, and the economies that are able to put in place reforms driving revenue will probably emerge the better for it. But it's not necessarily going to be that easy all round. South Africa last year was the beneficiary of something of a mining windfall. As the world focuses on a clean energy transition, and I'm sure we'll hear more about that later in this session, we know that we were seeing demand for the metals being produced in South Africa. This helped drive corporate income taxes. The situation was not as negative as initially feared. But a large number of other countries still have to grapple with revenue issues of their own. In Ghana, there is a live debate underway around the introduction of an e-levy, a levy on electronic transactions, as the government tries to do everything that it can to formalize the economy to broaden the tax base. In Kenya, under an IMF program, Kenya was an outperformer last year, having reversed some of its COVID-era tax cuts. But going forward with elections in the country in 2022, and what we would normally expect to see as a slowing of private sector momentum, is it going to be possible for Kenya to keep on outperforming on its revenue targets and reassuring on its public debt ratios? And finally, in Nigeria, a year before elections in 2023, some key issues that need to be grappled with regarding the fuel subsidy. With the passage of the recent petroleum industry legislation, for legal reasons, Nigeria needs to think of getting rid of that subsidy. There had earlier been pledges of fuel subsidy reform in the second half of the year. This will go some way towards boosting the revenue that Nigeria earns from oil. Much more of it will make its way to the Federation account if the fuel subsidy is addressed. But already there are mixed messages on the likelihood of that reform taking place. And all of this is in the background. Different countries are going at different speeds in terms of the embrace of reform, but the same considerations, the same constraints seem to apply almost across the board. And that is that African economies, even if they look to some growth recovery, will face the constraint of having to raise a lot more revenue in a short space of time to reassure on debt ratios. What about the broader debt initiatives? We'll be hearing more about this from Lanre, but there was very weak take-up, all things considered, of the G20 debt service suspension initiative. A number of countries, 3 so far, have opted to go for common framework type restructuring. And that too has been progressing at a different speed. Zambia is likely to provide the first test case of a country with a substantial amount of Eurobond debt, private sector creditors being involved, and also a lot of debt that is owed to China. How easy will it be to achieve agreement amongst the different creditors? Can it happen in a timely way? Will it allow for the resumption of IMF lending to Zambia very quickly? And most importantly at all, will it restore market access for Zambia? Will it encourage other African sovereigns that face debt issues of their own to think about restructuring as a means of reducing their overall indebtedness, dealing with the overhang of public debt and freeing up the space for more growth-oriented spending? There is lots of uncertainty ahead. Just in conclusion, it's also going to be an important political year, as we know, for the Africa region. Elections in Angola, elections in Kenya. This comes against a very difficult backdrop. In Angola, with the collapse of oil prices in late 2014, even though oil prices are doing a lot better now, this had taken its toll on the country's growth rate. There was a certain amount of discontent, even as reforms were being embraced. And this may well be reflected in terms of the pressures that we see around elections. In Kenya, already mentioned earlier, there tends to be greater uncertainty facing the private sector, a slowdown in investment until the uncertainty around elections is behind the country. And this does raise questions over how Kenya is going to be able to reassure on its IMF-led reforms, emerge with a healthier growth rate and a healthier balance sheet, given the likely slowdown that we'll see around the election time. And also, in the bigger economies, as final closing statements, Nigeria and South Africa. Although Nigeria only faces elections next year, expect to see a vast amount of interest in the choice of presidential nominees from the different parties. Look closely at the extent to which this allows for reform to take center stage or not. The risk is that some of the more difficult decisions that would allow Nigeria to grow in a more healthy way, establish a sounder basis for future growth, may well be deferred. And in South Africa, at the end of the year, the ruling African National Congress faces a leadership election. A few years ago, there might have been a very easy assumption. Cyril Ramaphosa had been elected ANC leader with the smallest margin of victory of any ANC leader, but still with some mandate for reform. And South Africa too will face a key test because those ANC elections will be looked to very closely for the likelihood of securing a reform-oriented environment, a political environment that might allow for faster growth in the future. So to conclude then, what to expect of Africa in 2020? The bad news still is that vaccine inequity still has an impact on the region's prospects. The better news is that we don't expect necessarily, in the wake of the Omicron experience, that we're going to see the hard lockdowns of 2020. But we do need to be realistic about what the Africa region has been through and the challenges that lie ahead. Those countries that are able to seize the mantle of reform, that are able to find the conditions that allow for reform to be rolled out, will likely reassure on what has happened to public indebtedness, will be able to resume a growth path even sooner. Back to you, Lanre, to talk about more of these issues in greater depth.
Razia, thank you so much for getting us started. A great overview. Just a couple of highlights that for me really stand out. I think the point around the tightening of global financial conditions is very, very important this year. And the implications of that should not be taken lightly for many African economies. And also the point you make around the need for revenue mobilization. This was already an issue going into the pandemic, and the last 2 years have amplified this quite dramatically. And there are no easy answers to how to meet that challenge, but absolutely that is going to be, I think, high on the agenda for this year and well beyond that. Thank you very much, Razia. I'm sure we'll pick up on some more of those points as we go on. I'm actually the second presenter, so just picking up on where you left off, there are three things that I want to look at. The first you've already touched on, which is debt. Now, if you've been following Africa in recent years, you'll know that there's a bit of a debt issue that has been growing there for some time. This has really been amplified over the last couple of years, again, due to the pandemic, but it's not a new issue. I've picked it as one of my sort of top 3 focus areas because I think 2022 is going to be a bit of a defining year in terms of where this goes next. And there are a couple of factors, or a few factors, to me, I think need to be borne in mind in that respect. Overall, I think a bit of a crunch is coming for several reasons. The first is that the debt service suspension initiative has ended. This was introduced, of course, in the early days of the pandemic as a way of alleviating the pressure from debt service repayments, which are the real problem across sub-Saharan Africa. It's not so much that the region or the continent has too much debt in absolute terms. I believe the expected debt to GDP ratio, or rather the debt to GDP ratio is expected to peak at around 70% in 2021 or this year, and then to start dropping, which is in global terms, nothing particularly dramatic. But the problem is that a lot of African governments were already struggling with debt service repayments before the pandemic hit. Now, with the lapsing of the DSSI, you are now going back to a situation where you're confronted with a fairly hefty bill, a bill that has only grown over the last 2 years because, of course, one of the main responses to the pandemic has been to borrow and borrow more, and that has included a lot of African countries. At the same time, there's not that much to lament about the ending of the DSSI because, as many people have rightly pointed out from the very beginning, what was proposed was really sort of a bit of a plaster on a fairly serious wound, and it was never really going to solve the problem. And even with the 2 years of this debt suspension initiative, the numbers aren't that great. So according to the Jubilee Debt Campaign, among the 73 countries that have been eligible for debt relief, they've actually paid out $36.4 billion over the last 2 years, and they've received around just under $11 billion in debt relief. So already there's a big question around, well, how effective has this been? And I think the honest answer is, well, it could have been worse, but honestly, it wouldn't have been that much worse if you didn't have this, which raises the bigger point, which Razia also touched on, which is the so-called common framework, which is, of course, an initiative agreed upon by the G20 aimed at debt restructuring. Again, Razia has already made the point that only 3 countries have applied so far, which is hardly encouraging. And even with those countries that have applied to the common framework, progress has been limited to non-existent. The IMF in December 2021 warned that the common framework needs to be stepped up in 2022, and it's very difficult to argue with that. They used some fairly dramatic language saying that unless there is a significant upscaling of the common framework and moves towards debt restructuring, that some economies might be looking at, or some countries might be looking at, economic collapse. Now, for the IMF to use language like that should give us a good indication of just how serious the situation is. And I would argue that there are definitely some candidates in Africa for that kind of scenario. There's a lot of countries that were really struggling with debt service repayments before this pandemic. And I suspect that there are a lot of governments out there that are kind of being quiet about the real nature of their debt service status, and just kind of hoping that something happens before things come to a head. The reason that the uptake and sort of the general openness around debt has been a little, not many governments have been that forthcoming is for good reason, because, once you admit you have a debt problem, life gets a lot harder in terms of trying to borrow more money, especially from capital markets, which have become one of the main ways that African economies over the last decade to decade and a half have raised money to fund their development. And that's also one of the big issues with the whole debt relief effort globally, and that is the role of the private sector. So we all know that, when was it? A couple of decades ago, Africa had a big round of debt relief. That was, of course, mainly just negotiations with the Paris Club and trying to get, the IFIs and, the bilateral donors to write off debt. This time, it's a bit of a different game. This time, the private sector is a much more significant part of the debt burden. More specifically and more importantly, when it comes to debt service repayments. So the estimate is that more than half of debt service payments are already owed to private creditors rather than IFIs or bilateral lenders or sovereign lenders. And a couple of statistics there. Of the $36.4 billion that was repaid during the pandemic, during 2 years of the pandemic, the biggest chunk of it went to private creditors, almost $15 billion. And for me, the most telling figure is that private creditors only suspended 0.2% of debt repayments. And that says, and that's kind of the elephant in the room, is that the private sector really isn't interested in debt relief. And again, for good reason, because they don't have any particular incentive. The market is a good place to go to raise money if you want to, and African economies have been taking advantage of that opportunity. But the market is also a very unforgiving place when it comes to repayment. And there's really not much pressure on them to budge on their position, it's not really our problem. And that's kind of been the narrative since. And without the buy-in from private creditors and the private sector in terms of debt relief efforts, which, as I've indicated already, not that compelling, I think this is going to be basically mission impossible. And my assumptions for the year are that you're not going to see a meaningful deviation from that position. So long story short, there's a crunch coming and there's no obvious answer to it. I think Razia was absolutely right in saying revenue mobilization is key. But again, there are no easy answers. A final point, which Razia also mentioned, is rate hikes coming in the US. The Fed is expected now to raise rates 3 times during 2022. And long story short, what that means is that the US dollar denominated debt that Africa has, which is a big chunk of the external debt, is going to become even more expensive to service. So all in all, I think very difficult year. And the debt issue is going to come to a head to some extent. And I think you're going to see some countries really kind of struggle with this. Second issue, briefly, geopolitics. So, I don't want to spend a huge amount of time on this, but it's an issue that has become a sort of popular theme when it comes to Africa in recent years. If you've been following the continent, you'll know that there's been a flurry of activity of other parts of the world looking for commercial opportunity and economic engagement in Africa. We all know about China in Africa, but it's now a fairly sort of broad spectrum of players that are out there looking to do business with the continent, looking to build political and economic ties with the continent. What I would say for this year is that more than maybe not so much a prediction, but more of just kind of like a bit of a warning of like, don't get too carried away with this narrative of a scramble for Africa. That's great for news headlines, and the media has had a field day with that. This idea that there's this sort of new imperial scramble going on for the continent. I think that's a misreading of the trend. I would say overall, it's a positive trend. What you have is increased global competition for opportunities with the continent. And I think that is going to continue this year. It's proven surprisingly resilient in the face of the pandemic, and before that, in the face of the commodities slump, both of which have had a pretty disastrous effect on growth and development on the continent. But it hasn't deterred interest. The only real risk is the supposed rivalry between the U.S. and China when it comes to this. Again, I would say my take on it is that this is a bit overplayed. Most of that supposed rivalry is kind of belligerence from the US towards China. But my take on that is that the bark is a lot worse than the bite on that. I don't think you're going to see meaningful confrontation on that front. And I don't think you're going to see necessarily African countries and governments being compromised by that kind of geopolitical competition. I would say there is more upside to this than downside potentially. And outside of the largely sort of rhetorical back and forth between Washington and Beijing, a lot of other countries are just kind of getting on with it. And if you can see the slide, there's just a few examples there of DP World out of Dubai. They've started construction of a $1 billion port project in Senegal, biggest port project, private port project in Africa to date, I believe, biggest foreign investment ever in Senegal. Turkey is one of the many players looking for opportunities. They had a big summit in Istanbul in December, and the good old UK is hosting its second UK Africa summit tomorrow, I believe it is. And the point here being that this is going to continue to play a role, and it's an opportunity for Africa to mobilize some of the investment that it needs. I think it should be treated as an opportunity, and African governments would be wise to make the most of this and leverage this in 2022. Finally, instability, not a nice topic, not a fun topic, but I think an important one. This has crept back up the agenda in recent years. We all know about what's been happening in Ethiopia, unless you've been avoiding the news completely for the last 18 months or so. But for me, again, here, I'm not interested in sort of dramatic media and news headlines about fragile states and military coups in Africa and all the sort of negative connotations that come with that. The bottom line is that instability is extremely bad for any kind of economic development and any kind of business. And without that, we can't have a meaningful conversation around, socioeconomic development on the continent. What's also worrying is that in certain regions, and I think particularly in the Sahel and West Africa, you're looking at a situation in which there's the potential for spillover across borders, and that can have all sorts of detrimental effects. Now, I don't want to get too much into that. My sort of point to watch in that respect for this year is how Africa responds to some of these quote unquote hotspots. Just recently, ECOWAS, that is the Economic Community of West African States, they've really tried to clamp down on Mali and set a bit of an example there. There was, of course, a coup in Mali last year, one of at least a couple of coups in the region, another one in Guinea late last year. And for me, this year is going to be a bit of a test of resolve and resilience when it comes to responding to these crises. And for me, the two areas to really watch are West Africa and the extent to which efforts by the regional bloc, be they economic or military, are able to kind of put a lid on this and set the precedent to say, look, here's a red line, and you can't go beyond that. Similarly, in Mozambique, the Southern African Development Community, they have of course started a troop deployment to the north of the country, where there's an insurgency that's been going on. If you've been following the news, you'll know that's a threat to billions of dollars worth of investment, not to mention the people who live there. And there too, it's going to be very important to see how successful or unsuccessful this regional intervention is. So for me, the point on instability is what is the response? And what are the implications of the success or failure of a response? Because if it fails, the message is, well, you don't have to worry about punitive measures. But if it succeeds, then what we will hopefully see is, a receding of this narrative of instability and the reality thereof as well. And I'm up to 13 and a half minutes, so I will stop there. But those are for me three important issues to watch this year. All right, and on that note, moving on swiftly, we'll go over to Simba Mutasa of Norfund, who's going to give us his take.
Thank you very much, Lanre. It's an absolute pleasure to be here with you all today. I'd like to firstly start off by thanking our attendees, I think, for taking time out of their busy schedules. There's nothing worse than that January flurry, so it is greatly appreciated that you take time out. And to my fellow panel members, thank you very much for bringing your expertise and experience. I'm thoroughly looking forward to having a fruitful, constructive, and open exchanges. And having listened to the first two, where I think I was taking more notes than actually thinking about what I was going to say, I think it's testament to the insights you guys are bringing. Throughout my career, I've actually learned the value of a good disclaimer. So before I share my insights on the topic at hand, I think it's important that I state the following. Firstly, Africa is a continent of many countries. And even, in these countries, they consist of many, some people would term tribes. I tend to prefer the term kingdoms. So even if I directionally can sit here and talk about Africa as a continent, we have to always just remember that the nuances at a country, regional, and so forth level are actually always very different, and there's many factors that can change this. Secondly, more often than not, there's a disconnect between the impact from where we see the world versus where the average person on the street is. And the sad reality of our beloved continent is that is actually the majority of our population. So I will try and be all-encompassing, but if I fail, I will draw everyone back to this clause in my disclaimer. Lastly, and I won't say more importantly, but quite pertinently, I started my career advising companies across Africa. And central to that was building these business plan and models that forecasted their supposed performance, over a 10, 15, 20-year period. And later in my career, some of my juniors found a model that I had built about 12 years prior. Now, much to my surprise, the level of accuracy was actually not that far off. I think from recollection, the financials of the revenues and profitability was about 10 to 15% off over a forecast period. Now, I know we're talking about what to expect, but before anyone thinks that I have this Yoda-esque talent at determining what to expect, when you actually looked at the details of what I'd forecasted versus what was achieved, everything was off. Yes, high levels, the numbers were accurate, but in the detail, everything was completely different. To contextualize, I had forecasted a world where the mobile industry did not reach a 4G or a data world. I frankly speaking, forecasted that they would have minutes of use to perpetuity. So I will put my hand up and say that my track record of knowing what to expect or how things are going to unfold is far from stellar. Now, if I pause for a moment, I think the point I just touched on here taught me a very valuable lesson, and I think one pertinent for the discussion we're having today. And that is that it's integral for all of us to bear in mind that it is easy to have a higher sense of accuracy over big things, but it's extremely difficult to determine the steps to get there. As we've seen with the sudden emergence of COVID, there are many variables that can and will change the way things unfold during the course of 2022. But what is key is the flexibility. Flexibility of one mind, flexibility of teams, flexibility of organizations. Our focus must be on understanding the broader trends and adapting quickly to the events, but also staying resolute to a longer-term vision and not losing the need to always strike a balance between being realistic and remaining optimistic. Now that I'm done with my disclaimer, let me get to the matter at hand. Africa in 2022, what to expect. I'll try and touch on a few themes that I see as the overarching backdrop that's setting the tone for 2022. And I thoroughly look forward to debating these later and obviously other topics that my counterparts are going to raise. Firstly, COVID. Now, I know this is probably the most used word or term over the last few years, but in all aspects of life, it has seriously affected us. And I think Razia touched on it, that we are getting into a period where we're going to start seeing the real impact of it, financially, socially, economically, and so forth. Now, one thing is clear, I'm not a scientist, so I have no opinion on, whether we are past it, per se. What I am confident about is that we're learning to better adapt to life with this continually mutating virus. The first thing that we've seen gaining momentum is the unwinding of COVID measures. And these are bucketed into what I'll term two silos. Firstly, those focused on restricting movement and gathering of people. I anticipate that these will continue being unwound, as we've probably seen across most of the continent, and that the significant and the most significant being lockdown measures. As much as people will benefit from the increased ability to socialize, the increased ability and ease of movement will carry significant benefits for the formal and informal sector. Now, given the proportion of our population dependent on the informal sector, this is something we can't underestimate the importance of. Separately, related to travel, I think in addition to from a global perspective at least, international travel will hopefully start to normalize, and that will carry significant benefits for sectors that have struggled in the pandemic, for example, tourism. I think when it comes to unwinding of lockdown measures, a key marker we all need to keep a pulse on is whether the virus will mutate to a point where measures are dropped, i.e. the extent of the symptoms decreases, or will vaccination rates get to the required threshold. And I think Razia touched on vaccine inequality and uptake rates and what impact that could have. But I think those are the two key things we need to keep an eye on. Secondly, are the fiscal measures. Now we've seen a lot of the measures put in place by governments in terms of stimulus packages to support economies are beginning to be unwound. And I think the key question we will need to look out for is what will be the result of this reduction or increase in interest rates, and how will that affect already squeezed disposable income? And building onto that, what impact will that have in terms of growth rates as governments try and strike that balance between increasing rates and matching with the growth rates? The one thing that is clear is we're now going to get into a point where economically we're going to see the damage that COVID has cost us, and the impact that this damage has is not always going to manifest or in terms of economic impact, but typically we'll see it in most cases through job losses. And when you start being aware of some of the costs of those job losses, which can sometimes manifest in stuff like social insecurity and so forth. So I think that is a key marker that we all need to be aware of and keep our eye on. Thirdly, I'll touch briefly on supply chains, given this is somewhat linked to inflationary pressure we are seeing globally. High level, the international supply chain crisis is improving, but is far from over, and broadly speaking, remains unstable. And the risk here is that this could feed into various inflation profiles, making them upward sticky for longer. We have seen an unwinding of, the lag, but, I think as I've tried to allude, we still see that this will drag out for, a period during 2022. Now, I can't talk about Africa and not touch on commodity prices. Now, the economies that have China as a major export market need to grasp the new reality that even as the Chinese government proceeds to stimulate its economy, the country's economic growth rate has fallen to about 5%. For context, this is the lowest that they've achieved in 30 years. And it does start to raise questions about whether after several decades of remarkably high catch-up growth as a developing country, China is now facing a more modest growth phase in its economic evolution. So for 2022, I think the key question we should be asking and looking out for is whether they'll start to reverse these changes and allow a somewhat faster economic expansion, which would prove a considerable boost to commodities and commodity exporters. Lastly, and personally, one of the areas that I'm most excited about is the infrastructure-led growth, which I believe will be a key theme in 2022. It's well documented that the key to development on the African continent and foundation for its industrialization and modernization is energy. So considering Africa's vast natural resources combined with its unparalleled potential for renewable energy, I strongly believe that the continent is posed to benefit exponentially from the energy sector, which is projected to promote economic development through creation of jobs, emergence of new industries, and I believe will play a key area I believe this will be a key area and something that we should track, during 2022 and beyond. So in conclusion, despite all the challenges that we face, I remain optimistic. I've tried to briefly cover a few themes. I see mapping the overarching landscape for 2022, but as I alluded to earlier, I am covered by my disclaimer, firstly, but secondly, and most importantly, there are countless number of events that can happen either locally, regionally, or globally that will drastically shift what we're currently expecting. So it's important for us all to remain flexible and adapt to an ever-changing environment. Thank you.
And thank you very much, Simba. And thank you for issuing the disclaimer. And just reminding us all, as we all know, Africa is in fact not a country. So while we may speak in general terms here, there is, of course, a tremendous amount of nuance. And, as you pointed out, so many variables that are going to impact exactly what happens. But key issues you've touched on there as well, which no doubt we're going to expand on later. Thank you very much, Simba. Moving on to our next speaker, Robert Hutchinson from Control Risks. Over to you.
Good afternoon, everybody. And again, thank you very much to the Norwegian Business Association for inviting me and Control Risks to this annual event. As a first-time NABA panelist, I can only ask that you're patient and kind with your questions. So we'll kick off and see where we go. Next slide, please. Brilliant, thank you very much. So Control Risk helps clients identify, understand, and mitigate political security and integrity risks. We have a presence in 6 continents with 42 offices that we help our clients wherever they may be, both at a strategic, operational, and tactical level. We have roughly 40 years of experience in sub-Saharan Africa with registered entities in Chad, Kenya, Libya, Nigeria, Mauritania, Mozambique, Senegal, and South Africa. We support countries across every sector, in Africa, including some of the largest investors into the continent. So that's a bit of context in terms of perhaps why I've been invited to speak here. Next slide, please. Resilience forms the central theme of my presentation to this audience. And given the presentations we've already had from the team, from Razia, from Lanre, from Simba, resilience is at the core. It includes consideration of the impact of the resilience of economies, societies, politics. And although not analysed here today, setting at the forefront of my mind the resilience or the fragility of our natural environment. As Africa has returned to economic growth after recession 2020, but its recovery remains slow and uneven. The continent is being held back by the fact that most governments lack fiscal headroom to engage in significant prolonged stimulus spending, leaving post-pandemic recovery dependent on often underdeveloped private sectors. This is where we're here for the investor confidence to increase and support that African growth. One of the reasons African governments don't have this fiscal headroom is that Africa, as has been mentioned, is facing debt crisis. At the end of the last year, the debt to GDP ratio leveled at an average of around 70% across Africa, with about 100% of the GDP being consumed in 9 countries. Exacerbating this problem is the fact that the debt landscape is more fragmented than ever been, undermining its effectiveness of any debt relief or restructuring initiatives that have been mentioned during this discussion so far. These economic challenges are putting pressure on political stability. This is truly true globally. We are seeing populist parties in Europe and last year's contentious elections in the US, but it's particularly acute in sub-Saharan Africa because in many African countries, the economic challenges are greater and the democratic structures are less established. While the coup d'etat we have seen in Mali, Chad, Guinea, and Sudan over the course of the pandemic all have their individual drivers, there's no doubt that these pandemic-driven economic challenges are contributing to this volatility. Economic challenges are also driving a host of other challenges, increased economically motivated crime, and underlying, together with political tensions, the type of large-scale unrest seen in Senegal last March or in South Africa last July. The militancy landscape is also becoming increasingly fragmented, as we're seeing in the Sahel. All of this volatility is making business environments unpredictable, and in such environment is not sufficient for commercial operations to be simply in a position to respond to crises as they emerge on a piece-by-piece scale. To be resilient, organizations need to invest leadership, time, resources to understand the center of gravity of their investment and their investment locations. What are the key enablers? What are the key vulnerabilities? What are the key capabilities and dependencies? And what plans can be developed thereafter to identify and respond and recover from disruption? You can see on the graph I identified in front of you that there seems to be a causation between a fall in GDP, poor performance economically, and increase in coups in sub-Saharan Africa. If we add briefly to that the influence of the environment and environmental degradation, you may be able to develop a picture of your own as to where direction of travel may take us without an ESG formatting to that progress, ensuring that stability and resilience at a macro level. Next slide, please. Recovery. Despite clear challenges across the continent, there are silver linings, to be glad to know, at least from our view. Africa's economic recovery will be slow, it will be uneven, but that does not mean that there are not some hugely exciting opportunities. Pandemic-related economic challenges are prompting policy rethinks in ways that could open investment opportunities. Oil-dependent economies, as have been mentioned already, are looking at diversification. Supply chain disruption is adding impetus to efforts to develop domestic manufacturing and promote regional linkages. Cash-strapped governments are looking to concessions models or public-private partnerships to develop infrastructure, and capital flight and external debt pressures will provide strong motivation to develop African capital markets. All these things will continue in 2022. A few countries are worth special mention. In Angola, for example, over the course of Lourenço's presidency, there have been really substantial reforms to ensure fiscal stability, solve monetary challenges by moving to a free floating exchange rate, reduce local content requirements, and develop economic sectors beyond the country's traditional resilience in oil and gas. The areas in which there have been most progress, both improve the regulatory environment and pushing out to take vested interests, are in mining, finance, and telecommunications. Progress likely to continue, one hopes, despite the elections. In Tanzania, Another key example, the death of President John Pombe Magufuli in March last year saw President Salma Suluhu Hassan take office. The President, Hassan, has adopted a more pragmatic stance towards foreign investment compared with the antagonistic stance of her predecessor, especially with regard to the mining sector, which has recently shown dividends with BHP investing into the country. A recent cabinet reshuffle has perhaps shown that the President, Salma Hassan, was considering is consolidating her authority, meaning that this trend is likely to accelerate, which is fantastic news for one of Kenya's neighbors. I say this as a Kenyan, of course. In South Africa, President Ramaphosa faces challenges, especially from within his own party ahead of the ANC's elective conference due later this year. The pace of reform from his administration has disappointed many. Nonetheless, the independent power producer programs has accelerated, accompanied by a number of other measures designed to help liberalize the power sector and solve the load shedding that has proved such a drag on South Africa's economic growth in recent years. Another sector worth noting is the digital economy, where despite some legislative volatility, the government has articulated detailed strategies to promote the sector. This progress is set to continue to 2022 again. In Senegal, the monopoly of the national power utility Senelec over the production, transportation, distribution of electricity ended in November last year, following the adoption in July of a new electricity code, which will see complete overhaul of the power sector and open opportunities for private sector participation. That, again, is great news. We could have drawn attention to Ethiopia as a positive case study. Unfortunately, as you'll be aware, there's a lot going on there, which has taken it from the direction of travel of positive inclusion of foreign investors and investors more broadly into an opening economy and generated fear as a result of events there. We wait and see with hope what will happen in 2022. Across the continent, there are also some specific sectors worth mentioning for 2022. One really positive thing to come out of the pandemic is a massive increase in healthcare and biotech capacity. As many of you will be aware, US billionaire Patrick Soon-Shiong's Immunity Bio will build a vaccine plant in Cape Town, South Africa. This will add to the vaccine being produced in South Africa already, with further projects to develop vaccine manufacturing capabilities in Senegal, Egypt, Morocco, and likely Rwanda. There is genome sequencing being established in Nigeria, Sierra Leone, and elsewhere. There is a huge amount of innovation based in part on research being conducted in Africa for Africa. All of this will not just help Africa respond with this pandemic, but will have a huge application post-pandemic, obviously in healthcare, but also in areas such as agriculture. Next slide, please. Africa's remarkably young demographics are a subject that has long been discussed, but are nonetheless important to mention. There's a tendency for certain narratives or talking points about Africa to emerge and then be discarded in favor of the next big thing. But that doesn't mean that those previously identified trends are no longer relevant. Africa's demographics, and in part, and particularly the youth of its population, is something that have been frequently commented on for the past decade or so, but has once again become pertinent to any discussion of the continent's risks and its future outlook. Whether the vast number of young Africans entering the workforce each year is a driver for economic growth or a source of volatility depends in large part on whether there are jobs for them or an environment for the youth to create employment of their own. And unfortunately, the economic challenges caused by COVID-19 means that there's less chance of such jobs being available. The cliche remains true, at least from a political perspective, that the past is a foreign land and they do things differently there. In the political landscape that the young population now live in, generally do not show the same loyalty to the liberation movements turned ruling parties prevalent across East and Southern Africa. While studies show that for various reasons, increasing urban populations are more likely to vote on issues rather than ethnic or religious identities. A lot has been said about the born-free generation in South Africa, whose weaker commitment to the ANC as a party that ended apartheid contributed to the party receiving its worst ever national election results last year in municipal elections. But those dynamics are happening in countries such as Namibia, Mozambique, and Tanzania. How long-standing ruling parties react to growing electoral threats will be a key thing to watch over the next electoral cycle. What we saw in Uganda in 2021, in Tanzania in 2020, and in Mozambique in 2019, was governments reacting to electoral challenges which observers identified as repression, harassment, and sometimes violence. This year, in addition to the Kenyan elections, and what we as Kenyans pray will be a peaceful transfer of power from President Kenyatta, one of the key elections to watch is Angola, where the ruling MPLA faces similar challenges from an opposition coalition. For President Lourenço, it will be a key test of whether he responds to that with populist policies or political repression, both, or something that derails long and delegitimizes the international reputation he's been building as a reformer. Further amplifying the importance of this young and urban population is the increasingly important role of social media. Social media use in Africa continues to increase faster than anywhere else in the world, and there's still huge scope for further growth. Nigeria provides an example of this. The End SARS process in 2020 was born out of a Twitter campaign and carried out by young Nigerians. The demonstration of that power of social media to mobilize and organize mass movements contributed to the government banning Twitter in June last year, and more recently, increasing regulatory scrutiny and taxation on social media companies. It's also worth noting that that ban on Twitter in Nigeria has been lifted, in part because governments, parties, need it to campaign ahead of the 2023 elections. The growing importance and penetration of social media raises a whole range of new risks that companies need to be aware of. Perhaps the most interesting and worrying of those is influence operations. State and non-state actors, both within Africa and externally, are increasingly engaged in the deliberate spreading of often false inflammatory narratives to advance their own objectives. Facebook, for example, has identified networks of coordinated, inauthentic behavior targeting African countries, originating from Iran, Israel, Russia, the UAE, Saudi Arabia, Egypt, France, and others. And at least 12 African governments are known to maintain the capacity to engage in such activities. We know that such influence operations can often exacerbate tensions within a country and therefore feed into other security threats, such as behavior. Such behavior has been detected around the Tigray conflict in Ethiopia, for example. But it also poses a direct security reputational risk to commercial operations. The anti-French sentiment that is rising in some parts of the Sahel currently, which poses a threat to French companies in the region, is undoubtedly being amplified and fueled by deliberate campaigns from geopolitical rivals. Thank you very much for your time. I really do appreciate it and look forward to the panel discussion. Thank you.
Thank you very much, Robert. Great points there on the demographics. We all know about the Africa's youth bulge. The narrative, as you rightly point out, is often that this is a windfall waiting to happen. But of course, it's key how governments respond to the growing needs of their youth populations if we are to reap any of those benefits. We'll pick up on some of these points during the discussion, no doubt. Now, before we go into the final two presentations, we're going to hear a lot more about the energy and power sector, which is, of course, one of the big issues globally right now, not just in Africa. I just want to encourage everyone who is in attendance. There are hundreds of you watching. Please do submit your questions or comments that we can weave into the discussion once we get through the presentations. Make sure that you post them in the Q&A section and rather than the chat section so that we can pick up on them. And without further ado, I'll hand over to our next presenter, Wole Shonibare, who is going to look at the power sector for 2022.
Thank you very much, Lanre and colleagues. Good afternoon. Thank you to NABA for the invitation to participate in this timely event. I am very pleased to be here. So my intervention will be focused on the energy sector in Africa and the key trends that will shape it in 2022. The decarbonization of the world's economy is a top priority and will mostly require the overhauling of the global energy system. But how will this affect Africa, where countries are still struggling to provide universal access for their growing populations? What are the necessary considerations to be made to policies, technology, finance, and business models to ensure a just energy transition for Africa for 2022 and beyond? So let me start with a few words about the African Development Bank. The bank was established in 1964. As you know, the bank is the premier development finance institution For Africa, 81 countries, shareholders, both regional and non-regional. It is a triple-rated institution, and we recently secured a historic capital increase. The bank currently has $28 billion portfolio of operations designed around 5 development priorities: energy, industry, regional integration, agriculture, and quality of life. Today, I will focus on Light Up and Power Africa. So the need to create accelerated efforts to power the continent is greater than ever before, as 80% of the world's population without access to electricity now lives in Africa. Since 2000, sub-Saharan Africa has steadily increased the number of people with access to electricity. However, the pandemic has reversed some of this progress, and for the first time in more than a decade, the number of African people with access to electricity has actually, with access to electricity has actually declined a little bit. So leaving 600 million Africans in the dark in 2021. It is therefore imperative that we find a solution to this access deficit, especially considering the continent's structural transformations, which include demographic changes, increase in urbanization, and in industrial growth that will further drive energy consumption. The assumptions of governments in terms of reaching universal access by 2030 require a 5-fold increase in power sector investment, mostly in low carbon generation, as well as grid networks. As we mentioned earlier, the pandemic has disrupted the continent's effort to increase power generation, as energy capacity additions have actually slowed to 7%. If we look over the pandemic period, a growth rate that is 3 times lower than what was observed 4 years prior to COVID, where growth was closer to 24%. So making up for the current deficit of energy supply and maintaining grid infrastructure requires significant ramp up to spending to over $100 billion a year, with $51 billion for transmission and distribution lines, $34 billion for grid generation, and $17 billion for off-grid systems. The prospects for Africa's power supply investment will be stronger if regional endowments are considered, as the lowest cost electricity generation mix varies across the region of the continent, depending on where you go. This will shape different energy transition pathways across the different regions. So for instance, North Africa relies heavily on gas. This region has already reached universal access and needs to focus on decarbonizing its power systems with solar and wind technology, whilst exploring opportunities offered by green hydrogen, for instance. Similarly, South Africa, which relies mostly on coal, has almost achieved universal access to electricity, but suffers from severe load shedding with increasing pressure to decarbonize its power system. On the other hand, West Africa, Central Africa, and East Africa have acute access deficits and need to significantly increase their power production whilst seizing the opportunity to harness their solar, hydro, geothermal, and gas resources via least cost solutions. Africa's contribution towards global greenhouse gas emissions has been marginal and accounts for only 3% of cumulative global emissions since the dawn of the Industrial Revolution in the 19th century. Besides, energy contributes to only 1/3 of Africa's emissions, of which 75% comes from North Africa and South Africa combined. The fact that forestry and land use change emit more in Africa than the energy sector contrasts with the global picture where the energy sector represents more than 2/3 of greenhouse gas emissions. Although renewables will play an important role in Africa's pathway to net zero, African countries cannot rely solely on variable renewable energy to power their economies and accelerate their industrialization. Africa's generation potential is estimated to be 100 times higher than current levels, with encouraging prospects thanks to the declining trend in the cost of renewable energy generation. However, the degree to which solar and wind can be deployed is constrained by a number of factors, including the following. One, inherent intermittency. So switching to renewables can cause load balancing challenges for the grid systems. And we know many of the African countries have very weak grids. So this does not provide reliable baseload, which will remain the case as long as storage technology or storage capacity continues to be limited. Second, integration costs. And this isn't often discussed. System costs associated with managing variable renewable energy are usually not included in the calculations of the levelized cost of energy and not paid for by IPP developers. So if I give you an example of Kenya, for example, where these costs have amounted to an additional $50 million per year for one of their renewable energy projects. But these costs are often not factored into the comparisons that we do. So whilst we are very much in favor of renewables, we need a realistic assessment of what needs to be done in order to anchor more renewables. So this is a backdrop to the issue of transitional fuels such as natural gas, which pairs very well with variable renewable energy and presents reliable options to support the industrialization of the continent. So for instance, natural gas generators can ramp up quickly when variable renewable energy resources are not available. Lower natural gas prices help make renewables more affordable for consumers. I mean, obviously we're seeing higher prices right now, but generally one was expecting that the trend of prices will continue to go down over the long term. Gas technologies for power generations have become more flexible and cost efficient. And the construction time for natural gas plants is half that of geothermal and hydropower plants. The latest debate around the inclusion of gas in the European Union's taxonomy regulation for sustainable finance illustrate how topical this theme is. And we're going to hear a lot more about this in 2022 because there are arguments for and against the use of gas. Obviously, there's the methane issue as well. But for countries such as the ones in Africa, where countries still need to industrialize, we need to have a realistic view of the role that gas will be playing. So how will we finance the transition? Despite numerous pledges, climate finance flows remain far below the continent's investment needs. On average, Sub-Saharan Africa receives only $19 billion in climate finance per year, mostly for mitigation purposes. This is 4 times lower than North Africa and well below Africa's investment needs, which are estimated to range between $26 and $41 billion per year. And this is for adaptation alone. Interestingly, adaptation is more of a huge problem in Africa because we're suffering the effects of climate change rather than, obviously mitigation is an issue, but because we're not emitting that much, adaptation is huge for the continent. So we need to bring that to the center of the debate around the impact of climate change for Africa. Therefore, the private sector is expected to play a more active role if Africa is to raise the significant volumes of financing requirements to meet mitigation and adaptation needs. A positive development during COP26 was the 130 trillion of private finance committed by the Glasgow Financial Alliance for Net Zero. However, this financial firepower is yet to find its way to Africa. 2022 offers a historic opportunity with COP27 being held in Egypt, which provides Africa with the opportunity to lead on the debate around climate change, to shape that debate and to project Africa's voice. Countries such as South Africa are paving the way by forming the Just Energy Transition Partnerships with advanced economies to mobilize billions in financing to support the country's move away from coal. The African Development Bank has been at the core of Africa's power sector development for over half a century. We're committed to providing holistic support to our regional member countries in their energy transitions whilst accelerating electrification efforts. To do this, we have developed a suite of financial and policy-based solutions, from lending and credit enhancement solutions to private sector, to setting up bespoke funds, such as the Sustainable Energy Fund for Africa and other climate funds that we manage on our own account and on behalf of others. We have special initiatives such as the Desert to Power initiative, which aims to create the world's largest solar zone in the Sahel across 11 countries by delivering access to electricity for 250 million people and developing 10 gigawatts of solar generation capacity. Capacity building through the Africa NDC Hub and the Clean Dev Special Fund, where we help countries develop their NDCs. So in conclusion, 2022, the growth of the African energy sector will be driven by key issues around debt, climate finance, regional integration, decentralized generation, and technological innovations. According to the IMF, more than 20 African countries are at risk of debt distress. This leads to high interest rates that negatively impact project economics, as these projects are usually highly geared. We will have to address these issues and constraints over the course of 2022. Africa has borne the brunt of the bitter injustice of climate change. So we will also have to address this issue, particularly as we move towards COP27, opportunities for African countries to be able to shape the negotiations on critical issues such as loss and damage, climate finance, commitments, and just energy transitions. The development of the regional power markets also presents a solution for countries looking to move away and move beyond a single buyer model, selling to just one utility. As we know, many of the African utilities are very weak, have very weak balance sheets. So we want to move away from a single buyer model to regional power pools, enabling countries to exchange surplus energy or sell electricity across their borders. This is also in line with the AFCFTA to promote more interregional trade. And this theme is one of the African Union's top priorities that will drive the growth of the energy sector with the implementation of key initiatives such as the Africa Single Electricity Market, the Continental Power System Master Plan, and the Continental Transmission Master Plan. So I think we will leave it here. Very happy to take your questions. Thank you very much. Back to you, Lanre.
Well, thank you so much. The energy transition is, of course, one of the defining issues of our time, not just for Africa, but it's a question that every part of the globe is currently confronted with. And there are tough choices to be made. They're one of the big themes that has emerged early on, and it is critical, is the question of, well, what about all of those? What about all of those natural resources? What about all of those traditional sources of power that Africa has access to? Can we realistically expect the continent to just ditch those and move on? And that is going to be one of the key questions in how Africa manages that. And on that note, we're going to have another perspective on the energy transition. Last but by no means least, we have Jens Thomassen, who is a partner with AP Möller Capital, who's going to give us some of his thoughts on the energy sector in Africa. Jens, over to you.
Thank you very much, and thanks again for allowing me to present here. Translating a Norwegian saying into English, I think this is a bit like jumping after Wirkola. Wirkola was one of the famous Norwegian ski jumpers back in the days, probably around the time when African Development Bank was set up. And I guess one of the joys of coming up last is I can just agree with the previous speakers. I'll try to keep it short to avoid replication, and get into questions. But I wanted to just sort of touch quickly and respond on three topics. One is macro, two is the energy transition, and thirdly is sort of what is then the opportunity set in light of the energy transition for Africa. At the macro level, I mean, a lot of good things have been said. I would certainly caution people to use nuance and not generalize. 2021 was perhaps the year when we finally saw the end of the Africa rising story, and the bubble burst a little bit. We had three coups. Ethiopia, which has been a darling for the investors, have certainly taken a turn for the worse. But as Richard also mentioned, Tanzania has suddenly sort of come back from being a country where people struggle to get their heads around investments. And my former employer, BHP, have made a foray into the nickel sector there last week after having spent almost 20 years getting away from Africa. So I think that speaks volumes to that there are good opportunities there. Similarly, in Ivory Coast, where Wallace African Development Bank is hosted, we actually saw, I think we're all a bit nervous about last year's elections. I think it was very much primed for a challenging election. We do remember the civil war about a decade ago, but I think it was handled in a very stable manner, and I think we've seen Ivory Coast continue to grow economically, but also to remain politically relatively stable. So I think there are it's as Dickens would say, there's the two tails in this, and I think it very much comes up to the nuance and looking at the micro as well as the macro. On the macro level, we do still see the tailwinds, whether that's demographics. We are still looking at relatively high GDP growth despite the pandemics. We don't see the same spikes in recovery rates, but that's because we didn't have the GDP drops that we've seen during the early days of the pandemic in developed markets. So the baseline is very much there. Energy is very much an enabler for economic growth. I've spent probably most of my career looking at developing, building, and commercializing various forms of energy across the world, and the overall energy consumption in sub-Saharan Africa is about the same. It equates to about a light bulb of 60 watts per capita. South Africa may be excluded from that statistics, and Egypt has certainly sort of come a long way in the last few years. But there is a problem there that remains to be solved. And Wale touched very eloquently, as always, on some of the main inhibitors there. But despite that, we are looking at a market where we have probably the highest cost of electricity of any continent. So looking at tailored solutions that deal and operate within the constraints across various countries on the continent is pretty key. I do echo welcome Wallace's mention of moving away from the single buy model. We've seen both Senegal and a few other countries moving away from the monopolistic model. We've taken an initiative in that space and set up a company this summer called Lumica, which is planned to build about 0.5 gigawatts across the continent over the next 4 years in commercial and industrial power projects, which then also could hopefully start moving into areas like perhaps mini grids in due course. We invested in Aerono last year as well, who together with Gridworks, which is owned by CDC, is looking to build what they call macro grids in DRC. A very exciting, certainly pathfinding project. And again, we look forward to seeing that that emerging. The elephant in the room is, of course, I think what Walla was alluding to, that is climate change. And we have certainly seen DFIs, and I would say the European Commission probably spearheaded this initiative about 10 years ago about basically restricting capital access to thermal projects. Very much, I would say, at a broad level. I think we can certainly. I don't think anyone necessarily would argue against that. Bill Gates is also in his latest book an advocate for rather run and extend existing thermal plants than build new plants. I would certainly argue that from a moral, from a logical, and from a broader SDG perspective, particularly in light of the low CO2 emissions that the African continent contributes to, an exception should be granted to developing power projects in Africa, but I very much fear that battle is lost. There are the scant exceptions like the Global project in Mozambique, but the way we've dealt with this, because Africa is very much right core and center for what we want to invest in here at Model Capital, is that we developed a net zero model. So we will independently go out and offset, abate, or reduce CO2 emissions for our portfolio. And that is a way to basically avoid getting into an intellectually stimulating debate, which then further delays progress on critical infrastructure projects. Obviously across the value chain, generation is needed, transmission is needed. The critical constraint is, of course, creditworthy off-takers. And certainly the South African power pool has come a relatively long way. Being Norwegian myself, and of course NABA having a Norwegian roots, Nord Pool was probably I would say the brainchild of global power trading and liberalizing electricity markets. And many US IPPs would send off their young bright people to Norway, Sweden, or Denmark to learn power trading and learn how to deal in deregulated markets. So I think there is a tremendous knowledge transfer opportunity there from Norway to Africa. But we also need to recognize that we operate with some infrastructure constraints when it comes to grid stability. And unfortunately, as we saw here in Kenya last week, transmission line pops down and suddenly lights go out in northern Nairobi. So we are dealing in quite fragile and fragmented markets. Sticking on to the energy transitions theme, and Razia briefly mentioned onto this, there's also a tremendous opportunity here. You can look at any statistics you want, but the green energy transition, which I wholeheartedly embrace and believe in, and that's going to happen at a number of levels, whether that is EV charging infrastructure, whether that is transmission, whether that is methanol, ammonia, hydrogen, will require a lot of hard infrastructure. And I think if you look at IEA statistics, you're looking at a tripling or quadrupling of metal and minerals demands over the next 20, 30 years. If you then combine that with the analysis that 40% of the undeveloped minerals needed for the energy transition are located on the African continent, you can understand why BHP, which, having worked there quite a while ago, obviously as a fairly risk-averse organization when it comes to so-called political risk, has moved into Tanzania and is looking to hopefully continue to expand on the continent. So that obviously is brilliant or a positive step. I think but for that to grow at scale, obviously we need to deal with the constraints which are linked to infrastructure and skills and people. And I think for us as investors in focusing on Africa and other emerging markets now, we obviously want to create skilled jobs and help industrialize the continent. We have a very interesting investment in Gabon as a core investment, which is linked to an industrial zone. Some of you may know that Gabon banned export of logs a few years ago. Obviously, that created a bit of angst and nervousness, but as a result out of that, and I'm not suggesting sudden regulatory intervention in general, but what that is seen growing is an industrial zone where you now have beneficiation of wood products happening in Gabon, meaning that you basically capture more of the value on the continent rather than be seen as a raw materials exporter. So with that, I'll pause. A lot of good things have been said, and I look forward to many good questions. So I'll avoid repeating other previous speakers. But thank you very much.
Jens, thank you very much for expanding on the question, some of the issues around the energy transition and the energy sector in Africa, which we'll pick up on. A big thank you to all of our speakers. One of our presenters, unfortunately, has had to leave. Razia is no longer with us, but we will now have around 35 minutes to maybe unpack some of what we have covered, but also maybe try to touch on some of the things that we haven't looked at. And we've got a few questions that have come in as well. For me, one of the interesting things is that we haven't really spoken much about technology. And there is a question here in the chat about tech investment. And specifically, question is around what to watch in 2022 in the technology space, particularly in climate, agri, and food tech, and the associated venture capital space. Would anyone like to maybe look or maybe sort of touch on the tech sector and tech investment in particular across Africa, which has made a lot of headlines in recent years? We've seen a lot of fundraising going on. There's a lot of money going into things like fintech. How important of a theme might this be in 2022? Why haven't we touched on it as presenters is for me kind of an interesting one to explore, because you hear a lot about it. Is it being exaggerated, or is this going to be an important factor in 2022? Does anybody want to chime in on that? No, nobody? Any of the speakers? No. All right. Well, I mean, I might have a stab at it then. Tech investment. How significant is it going to be in 2022? Well, I'm not an expert. For me, I think what's interesting is the amount of money that's being raised. So it's grown significantly in recent years. I think the estimate is that by the end of last year, African tech startups will have raised like $5 billion in 2021, which is a new record, and they've been setting records year on year. For me, the sort of the cautionary note there is that most of this is going into fintech, i.e. sort of moving money around and facilitating payments. And for me, there's a question around how impactful that is in terms of socioeconomic development. So, the flip side to that way of looking at it, of course, is that it has the potential to drive financial inclusion. And just by virtue of the amount of money that's going in, what you're looking at is the development of an ecosystem, which will invariably spill over into some of these other sectors. So, sort of climate solutions. These are what you would call marginal or nascent spaces at the moment. Same with agri-tech and food tech. There's not a huge amount of money going into this yet, but these are growing sectors. How significant that will be in 2022, I'm not sure. I think you'll continue to see an overriding focus on fintech and the business of moving money around. Me, the question there is, well, you also need the economic base for people to move money around, right? There's no point having X amount of mobile money solutions if you don't have an income, because then you have nothing to move around. But that is that's a big question, and that's the sort of thing that will unfold in the long term. I don't think you're going to see tech investment reduce, but I think it's a process, and it's going to take a bit of time to really sort of get the impact in terms of development. I don't know whether any of the other speakers want to come in on this at this point. If not, I'll move on to.
Yeah, I think, and Londra, I think I just want to stress that the disclaimer I gave earlier is extending to this part of the discussion. But look, I think fintech, or the technology space, is very interesting, right? I think we are a continent where we have a long-standing history of jumping other areas. But I think the key thing that I always ask, and I think it's something that people need to also keep an eye on, is around, and you touched on it, Larry, is the ecosystem, right? So I think what you see is fintech, because of areas like the informal sector and so forth, they touch points are a lot more significant. And I think the key thing we need to keep track of that's actually going to drive it, one, is around the ecosystem growth. And that's everything from actual use for something, user base, viability financially, and the availability of cash or capital, whichever we may. So I do think it's going to be very interesting. I think the key thing that the need is there and the environment is there to foster a lot of technology. I think the key question is going to be which technology and springs out of it, right? And I think the key question comes in is going to be around how does the market look, right? I think the challenge you'll get is something may come up in a relatively small market like Botswana, where there's a relatively small population group, but with a lot of tech sort of things, you kind of need the expanse of population or users. So I think you will have a spring and probably lead with ones that can easily transcend the continent. And I think we, in terms of Africa, need to be thinking about how we can create and foster ecosystems for springing up a lot more, which I think is hindered a bit by fragmented markets.
Thank you.
Can I jump in there, Lanre?
Yeah, sure.
I think one of the, I was furiously trying to press my unmute button and notice the audible silence when you offered it up to everybody else to kind of speak to. But I think one of the key things that we need to identify is what is tech, what need are these options fulfilling, these tech options fulfilling? What is the ecosystem trying to resolve? What issues? When you dig into the weeds of it all, what is the need in order for this gap to be filled, and then the scale that comes with that? I don't think that there is a lack of availability of goodwill and or of finance in order to invest, given the size of the continent, given the demographic of the population, as we've discussed. But I do think that there is far more weariness to invest, courtesy of the dot-com era, in concepts that don't provide a viable solution to an existing problem or a perceived problem that can then be scaled at a rate that is proportionate to the investment that has been put down. So I think there is certainly going to be continued growth in this space, but I think it's going to be cautious and targeted for need. The other bit I'd just like to bridge to regards cybersecurity, and to what extent does that play a role in ensuring and providing assurance to the investments into the domain, whether it's fintech in that environment. And I think there's a world of investment an opportunity that could come in there for Africa regarding the education of the resilience, the governance, the security of the ability for these applications and systems to exist in an ecosystem that is sustainable and resilient.
Thank you, Robert. Back to the energy sector. There's a question here, and perhaps to Wale and Jens. We've spoken a lot about the energy transition, investment into renewables. We're all aware of how important these trends are. We're seeing a lot of activity in these spaces, but good question here around specifically, and to the point of nuance, which countries are sort of creating the kind of environment that's needed to really start to attract more meaningful investment when it comes to renewables. And I think it would be quite interesting to get a take on, what's working. And, by extension, what can be replicated perhaps across the continent. Wale or Jens, who would like to pick that one up?
Well, do you want to start?
I can start.
Wale,
yeah. Well, well, a useful reference is our annual publication, which is called the Electricity Regulatory Index for Africa. And there we try to benchmark the regulatory frameworks across different markets in Africa against international best practice. And you know, for 4 years consistently, Uganda has come top in that review, and there's no surprise that they have, because the utility is fairly well run. You know, one of the things that you have to think about in attracting investment is somebody has to be able to buy the power, and you have to have some level of payment assurance. You have to have rules that everybody understands. And also you need to be able to wheel that electricity. So the transmission and distribution and your collections, the entire value chain has to work, whether it's renewables or non-renewables. In relation to renewables in particular, if you don't have a strong grid and base load, you will not be able to anchor the renewables, which is intermittent energy. So there's some prerequisites. It's not just a case of let's go and do a renewable energy project. You know, if you don't have those basic things in place. So when you're looking across the continent, you have to look at countries where there's a track record of collection, paying the bills. There's some solid, you know, base load. And Uganda and other markets like Namibia have shown that they have that. And when you look at the regulation as well, when you look at their track record of paying IPPs, you know, other markets, although not markets such as Cote d'Ivoire, have had a pretty reasonable record in this regard as well. So, and Egypt has done incredibly well in the last few years in terms of bringing renewables on. And obviously we know about the South African ARI IPP program. So there are quite a number of examples to follow. Thank you.
Jens, before you respond to that, just a sort of additional point from another question here around the growing importance of a lot of the raw materials that are going to power the renewable energy transition, much of that being in Africa. There's a question here specifically around how do you ensure that we don't end up in a familiar scenario where there's very little beneficiation, especially in terms of economic development and impact on the population, specific, you know, primarily, or one of the most important issues being the creation of, you know, meaningful employment. So if you could maybe just weave that into your thoughts, would be great to get your perspective.
Yeah, so I mean, I fully support Wala that I would say some of the more forward-leaning countries that has been successful on the policy side are largely, examples like Uganda and Ivory Coast, and what comes with that. Why are they successful where some other countries may not have been? And that goes to unbundling and making sure you have cost-reflective tariffs and a system where basically collection rates match up with the wholesale cost of generation, and you have a reliable grid. Morocco, Egypt, and South Africa stand out because they managed to build renewables at scale. And I think that is the real challenge. If you look at the mobilize capital and you're looking to get to electrify the continent, then doing 20, 30, 40 megawatt deals is a waste of time, sorry to be blunt. We need a more systemic framework. And I think the way to deal with that is unbundling, deregulating, and allowing private sector to come in. Of course, and we talked briefly earlier on about Senegal, Egypt, allowing basically companies now to generate their own electricity, which in many other places you take for granted. The concern, of course, is that you start picking away the best customers for utilities, and they're left with the people that can't pay the bills. But maybe that is a risk we then have to address with separately rather than to prohibit investment, because public procurement through tender schemes in smaller grids is going to be a lot more challenging. I fully support your second concern and question around how do we basically create beneficiation and skilled jobs and meaningful jobs locally, and not just become a raw materials export and then importing the final product, which skews export-import balances, outsources jobs, and of course doesn't create local taxes. My old employer, BHP Billiton, which we briefly mentioned earlier on, of course built Mozambique, a large smelter. Why did that succeed? Is because you had access to good raw materials and access to low and reliable cost of electricity. So many of these things fuel each other in the sense that if you have a stable regulatory environment where you feel that you are and a predictable framework for investments, which I think many African countries do, I do believe there is a major difference between perceived and actual risk. Moody's does an annual study of project finance default rates, and despite having been through some good years, some challenging years, the African continent do a lot better than the US power market, which is a point lost on many other people. I do believe further that we need to work within ecosystems. I know this is something both AFDB, AFC, and I think also, unfortunately, Robert for calling Richard earlier on, but is critical. And we have an integrated ports business in Gabon that takes some of the cheapest cost manganese in the world and brings it to a port where then shipped to China. And we manage that whole supply chain ourselves. We have our own locomotives, our own wagons. We go and fix some of set tracks, rail tracks when they fall apart. And by doing so and having interdependencies with customers and companies, you can rely on, you don't need to rely on sovereign credit, which is the factor that is missing if you want to really build transformational national infrastructure.
Thank you, Jens. Moving on to another topic. We've touched on China a lot. It's impossible to talk about much of anything these days without factoring in China, just by virtue of its status as an ascending global power. But many of you will be aware that the Forum on China-Africa Cooperation took place just a few months ago, and one of the big takeaways from that was a shift in focus away from what has been the sort of traditionally dominant approach, which is big loans, big infrastructure loans from China, and them saying that we want to move towards a more investment-focused approach to Africa. And we've got a couple of questions here around that, like how do we see Chinese investment in Africa in 2022? And I think against that backdrop, there's an important question here of, is that going to materially impact how we see China engaging in terms of its capital deployment in 2022, or can we expect more of the same? Would anyone like to maybe touch on that one? Or is that too controversial? Yeah. Yes, please.
No, I'm Norwegian. We are known for making the Dutch seem polite, so maybe I can be relatively blunt there. I think the issue is when we come in as a traditional investor is that we don't always have the transparency on what is the true Chinese involvement. And when we just set up Untitled Chapter together with CDC, we took what was perhaps a naive attempt at acquiring Covert Energy Corporation in a public to private taker on the Lusaka Stock Exchange, which was unprecedented and perhaps for a reason. But one of the issues that came across was suddenly, of course, the Chinese debt trap unraveled, and then, of course, one of CEC's largest customers had the license revoked, and suddenly there were rumors about a nationalization of the largest customer. So I would say that a lot of that, I haven't seen a lot of examples like that in the last few years. I think there's probably some other macro themes going on in China that perhaps makes it less plausible for China to do sort of these government deals that we've seen some happening before. But I think China will continue and is a large player in the transformation of the African continent, whether that is through capital, through EPC companies, through supply of goods and services. So I don't think it's certainly for the projects we've looked at, we don't see a lot of interference that is not commercially related. But we do take note of a company called Alcazar Energy, which was sold here during the course of the summer to China Three Gorges. So there's still some activity. There's still capital chasing good companies and good deals, but I haven't seen a lot of the government arrangements that we perhaps were a bit nervous about before. But I don't know, Wale, perhaps if you have, or Simba, if you have some additional insights.
Well, I mean, we expect China to remain an actor for quite a long time because they just have the industrial capacity. If you look at who's building the infrastructure in Africa these days, whether they're publicly financed or privately financed, there's excess capacity in China, which has to go somewhere. And so Chinese contractors will continue to be very active in Africa. Investment flows may slow for a bit, but where there's demand, and Africa does have the demand, the demographic shift is happening and will continue to happen. That demand has to be fulfilled somehow. And so I fully expect China to remain very active. But they may be more choosy in their choice of projects, and as debt sustainability issues become more relevant, the investment will slow for countries that will have to reach agreement with the IMF to restructure their economies. Well, other countries will do quite well, and it's likely that the natural resource countries will see quite a bit of growth going forward. And so, yeah, it's a mixed bag.
Yeah, and Laura, I think just touching on that, I think obviously the two gentlemen have covered well, but I think another thing we just need to be conscious of is, we do have a very young population with higher unemployment rate, right? So I do think there's going to be a lot of interest around the relatively cheap cost of labor and what that could do from, probably more on the private investment side. So, I don't think it's going to drastically stop, but I think there will be a potential uptick around, call it equity, private equity investments in that capacity, trying to capitalize from that.
Just a couple of quick thoughts from me on the China and Africa. It seems to me that the sort of the engagement from China, it's often kind of reduced to almost this kind of one-dimensional thing. It's like this, you have this sort of monolithic China, and it's kind of, coming to take over Africa. And my sense has always been that there's this kind of caricaturing of the relationship that actually it's a lot more nuanced. It's a lot more complicated than it's often portrayed. And my impression is that China has kind of been gravitating away from that, financing big infrastructure projects, financing resource extraction projects for a number of years. So when you look at the technology space, for example, there's a lot going on there. The biggest music streaming service in Africa, for example, is Chinese owned. And they've been, I think there was a study carried out by McKinsey a few years ago where they did a sort of survey of Chinese companies active in Africa. And the estimate they came up with, it was that there were 10,000 Chinese companies across Africa, and that the majority of those were actually private. And, let's not forget that we're talking here about, this China-Africa thing really started to take off back in 2000. We're talking about 22 short years here of engagement. This is a fairly young, in big picture terms, this is a fairly young relationship. And China's changed a lot in those 22 years. And it's still evolving and growing. And I think that is reflected in the China-Africa relationship. Too often, this debate is sort of put down to China good or China bad. For me, the important thing is China real. So it's not about what you think of it. It's kind of understanding, well, whether you like it or not, Beijing is one of the most important places in the world right now, not just if you're an African government, pretty much anywhere. And the question is, what is your relationship with Beijing? And how do you make sure that the vast amounts of money that Beijing is putting out into the world, how do you make sure that that is something that you can leverage to drive meaningful economic development. So yeah, I don't see China going away. There might be momentary dips in investment and dips in engagement, but yeah, it's hard to see some sort of like retreat from Africa. I think we're going to see a continued evolution of this relationship more than anything else, really. Unless anyone has any more comments on that, there are a couple of questions around demographics here. And Robert, you focused on, one of your focus areas was demographics and the demographic dividend. And specifically, a question here is around policy responses. How are governments, if they are, responding to the challenge of meeting the rising needs? Principle among them often being the need for jobs and meaningful jobs across Africa, but also how do you, and is a sort of second related question around, managing this youth population in an urban setting, because we know there's a rapid urbanization going on, big challenge. These are big issues, big questions, but as it maybe sort of some top line thoughts on, well, what are we seeing by way of a policy response? What might we see? You made a good point earlier around elections in some of the key countries, and one of the key dynamics around that is going to be, well, how do you respond to your youth population?
Yeah, thank you very much. And when I look at Africa's demographics, I'm thrilled and horrified and frightened and thrilled in a cycle that's almost endless. And depending on where you catch you on an individual day, you'll pick up on a different sort of answer related to that. When you look at some of the fastest growing cities across in the world, you look at the growth of what Dar es Salaam is going to be, Kinshasa is going to be, Lagos is going to be. Those are some pretty interesting and wonderful statistics, but at the same time, deeply concerning if their growth is not met with some policy and governance that supports investment into and education of that population in order for coexistence to happen in a meaningful way at an individual societal level. So when I look at the policy component, who is looking at this in a meaningful way, and certainly I know the title of today's webinar is 2022. This is certainly beyond 2022. This is a thematic area that governments have to get their heads around and hands around that's going to take governments decades. One of the luxuries that China as a superpower has is the CCP having the ability to implement a decision in 2020 and to work through that decision for the next 100 years, potentially. The luxury of having a democratic governments in African states is that cycle of interest, self-interest, and voter interest, which is a little bit more short-term. And the concern that I have is how many governments are really generally engaged with a long-term 100-year view, 200-year view as to what their population is going to look like and the demographic shape is going to be in order to create policies and governance around that supports that sort of growth. I don't see, to be quite frank, governments looking at it in that sort of way. I do see governments, however, looking at investment in urban planning. That is happening. Looking at their energy requirements, that is happening. Looking at utilities, and that is happening. But in terms of the overall holistic view as to a approach at a level that is focused on the demographic shape to come, I don't quite frankly see that those dots being connected on that thematic issue in order to drive that to resolve and to address consistently that a governmental and whole of government approach to addressing that challenge. Regarding managing youth, that is going to be a significant challenge for numerous governments across Africa. Part of the reason why we've had internet shutdowns is because successive governments in sub-Saharan Africa have looked to the north during the Arab Spring and saw just what the mobilization of the youth could do for an unprepared government, or for a government that presumed it had the monopoly on violence. And that's certainly not the case. And so we've seen a response from successive governments from Ethiopia, Uganda, Zimbabwe, Tanzania, etc., and others to come, I'm sure, who have looked at the internet and thought we need to control this method of mobilization and organization. That, I think, is to come and is something that we need to contend with as investors and those people who support investors to make risk-aware decisions. So the short answer is, quite frankly, Lanre, whoever asked the question, is there is far more work to be done in developing a thematic approach by governments. And when I mean governments, I really mean at an individual governmental level, but also at an Africa level, because the borders that were drawn up by our colonial powers, as we know, in some places are quite mythical. So it is not a position, we do not have the luxury, very much like climate change, of dealing with this at an individual level. This is something that we're going to have to think about, particularly for those larger countries, in a very holistic way.
I share your sort of optimism and anxiety cycle when it comes to the demographics. It's like, depending on what day you're looking at it, it can be either very uplifting or quite terrifying, to be honest with you. And you're absolutely right. I mean, this is a huge, huge topic, and it will unfold over many years. I mean, let's hope for the best, I guess. Now, we're almost at the end. We only have 5 minutes left. Before I wrap up, does anybody have any final burning thoughts that they want to get out there, and to sort of wrap up the discussion? Otherwise, I'll just try and do a bit of a summary, and then we will be able to get on with our days. Anybody?
If I may, Lanre,
yes,
I think I really do love the question in 2022, what to expect. But given where we are in the spectrum of economic recovery, COVID and what happens next, et cetera, I think investors must have a broader view. And resilience, for me, coming back to the core theme of my presentation, it has got to be at the center of that. Which governments are resilient in terms of their approach to encouraging investment and will have a rule of law that enables that investment to flourish throughout its cycle, and which investors have a resilient portfolio and a resilient approach and a strategy to investing, understanding the nature of the risks that they're going to get involved with. Neither of those, I don't think many organizations or many governments are in a perfect position. It's a bit of a seesaw, but that understanding is way too much information out there to be triaging emergencies, on a case-by-case basis. The longer-term view is what's required in order to have that longer-term investment and to be long-term successful. And that requires a holistic view of that environment you get involved in. So yeah, that would be my parting comment. Thank you very much, Lanre.
Great, thank you, Robert. And on that note, some concluding remarks. We've covered a lot of ground. There is, of course, a lot more ground that we could cover, but some of the takeaways that stand out for me are that, of course, we are going to start this year looking towards the real fallout of the pandemic, but also the impact of the unwinding of a lot of the measures that have been introduced both globally and to a lesser extent in some African countries, and what that will mean for investment and policy on the continent. The loss of fiscal space, I think, is one of the key issues. Debt is something we've looked at a lot. I think that will continue. I think that will be one of the principal issues this year. And of course, not just in 2022, but beyond that, that lack of fiscal space is going to have real implications for what can and can't be done to not only recover from the pandemic, but sort of start to build a kind of momentum that we want and need to see when it comes to economic development on the continent. Another issue that obviously stands out is the energy transition, and what that will mean, not just in 2022. We know at the end of the year, COP27 will be in Egypt, big focal point, but from now until the end of this year and well beyond, this will be one of the defining issues. The big question for Africa seems to be how do we move towards a renewable energy mix, without the benefit of having been able to develop, using traditional means. That there's obvious tension there. The reality, of course, is you're dealing with a world that is increasingly disinterested in funding fossil fuels and traditional sources of energy. So there's a tension there that needs to be overcome. We'll see that play out in 2022 and beyond, no doubt. on that note, allow me to thank all the speakers. Thank you, everyone, so much for your time today, for your great presentations, for the discussion. Thank you for everyone who's joined in, everyone who's posted comments and questions. Apologies to those whose questions were not directly answered. Unfortunately, we are all subject to the constraints of time. Just sort of a couple of pieces of housekeeping. In case anyone is wondering, there will be a follow-up with a summary of everything that was discussed here today next week. And that will also include all the presentations that were given here today. So if you're keen to get your hands on the material, you will have the opportunity to do so. Another thing to just draw your attention to, and a sort of a quick plug for it for NABA here, is that the next member event is coming up just next week on the 26th of January. There's a briefing with Norway's ambassador to South Africa. That is the 26th of January from 11 to 11:45 CET. Have a look at the NABA website if you're interested. And of course, you can also get more information on what else we do here. And on that note, let's hope that 2022 is an improvement on the last 2 years. Take everything you heard here today with a pinch of salt. Let's see what happens in the next few months. But I am cautiously optimistic, and you can quote me on this, that the worst may actually be behind us. Let's hope so, and let's hope that Africa can respond positively to the last 2 years, and that we see, us not just returning to where we were, but hopefully also move beyond that. And on that note, bang on time, 3 p.m., I will be bringing proceedings to a close. Thank you again very much to everyone for joining today.
Thank you very much.
Take care.
Thank you very much, everyone.